From house hacking to flipping, find out which real estate strategy fits your financial goals best. Your path to wealth starts here. Welcome back. My name is Blake Alewelt, owner of the Bravo Ridge Group. In this video, we'll explore some of the most commonly used investment strategies to help you determine which aligns with your financial goals. As a real estate investor, there are several different approaches you can use to make some quick cash or grow your portfolio. With so many available, it can be overwhelming to determine which option is best for you. Let's dive in. Number 1, house hacking. House hacking is a strategy to generate income from your primary residence by renting out portions like a bedroom, an ADU or accessory dwelling unit, or 2/3 of a triplex. It's one of the easiest ways to start real estate investing and doesn't require any previous experience. If you already own a home or other rental property in the area with good demand for rental housing, you may already have everything you need to get started. If you haven't yet bought a rental property, don't let this scare you. You can break into house hacking with a traditional owner-occupied mortgage, such as conventional, FHA, or VA loan, with a down payment as little as 3 to 5%. If you're looking for a lender well-versed in these loans, let me know and I can point you to a few I've worked with. After tenants have moved in, you'll earn rental income, which you can use to offset your monthly mortgage payments, property taxes, and other expenses. If the rent exceeds your expenses, you'll even earn a little extra cash from the deal. Number 2, the Burr strategy. Burr is a real estate investing strategy that stands for buy, rehab, rent, refinance, repeat. Here's how it works. You start by buying a discounted property that needs either significant repairs or cosmetic improvements. You then increase its fair market value by rehabbing and renting it out. After your lender's seasoning period, which is how long you will have to own the property before they lend on the appraised value, you can convert your home equity into cash with a cash out refinance. The lender's seasoning period is usually between 6 and 12 months from the loan origination date. You can then repeat the process to continue building wealth. The Burr method may not be the best strategy for a new investor. Because several steps are involved in the process, it requires some real estate know-how to ensure everything goes as planned. It also requires more direct involvement in a rental property than some investors prefer. Another reason why Burr investing may not be the best real estate investment strategy for beginners is because of the financial commitment. The renovation costs and repairs could be significant depending on the property's condition. You may also have to pay for the monthly expenses out of pocket until the rehab is complete and you can rent out the property. The Burr method has several benefits that make it worth considering. You'll earn steady rental income from your tenants. The property will most likely appreciate while you own it, and you can also get a lump sum payout from your cash out refinance. Number 3, the PRR method, as in PRRR. PRR is a real estate investment strategy that stands for primary, rehab, rent, and repeat. It involves purchasing an undervalued or distressed property you use as your primary residence. You then rehab it and turn it into a rental. As you can tell, this is very similar to the Burr method. The main difference is that you live in the property you buy for a while instead of renting it out immediately. The PRR method is also simpler than the Burr, which means a beginner real estate investor interested in the Burr method may want to consider this method first. A good loan for this is the FHA 203K loan, which allows lenders to lend money for the purchase and renovations of the home. I can help you find lenders that are well versed in this type of loan if this is something you're looking for. Number 4, house flipping. House flipping, also known as fix and flipping, is a real estate investing strategy that involves buying a property, rehabbing it, and then quickly selling it at retail for a profit. Similar to the Burr strategy, house flipping involves buying a distressed or undervalued property, saying 70 to 80% ARV or after repair value, and make repairs and renovations. The main difference is that usually flippers don't rent or refinance properties. They're more interested in selling them and moving on to the next opportunity. This is a great strategy for experienced real estate investors who don't mind putting in the time and effort to rehab a home. Number 5, live and flip. The strategy of live and flipping is similar to fix and flipping. The main difference with this real estate investment strategy is that you live in the home you buy until you finish rehabbing and selling it. This allows you to make repairs and renovations at your own pace. Since there's no rush, you can take as long as you need to rehab the property. This can be as an important benefit you pay for the repairs out of pocket or do much of the renovation work yourself. This is normally how people get started in real estate. Number 6, real estate wholesaling. Real estate wholesaling strategy is ideal for those interested in structuring deals to earn cash. You can use this strategy to earn a down payment for a rental property or something else. Some investors prefer to specialize in this strategy to avoid being landlords altogether. There are 2 steps to the real estate wholesaling process. First, a wholesaler finds a motivated seller who owns a distressed property with some value add potential. For example, the property could be in a good neighborhood or need cosmetic improvements. The value add potential could also be when an investor is willing to trade to find a rental property in a community with high rental demand. Most of the time, sellers like these have tried unsuccessfully to sell their properties or don't think that they can because their homes are in poor condition. They may also have inherited properties they don't want and are willing to sell them at a discount just to be rid of the problem. In theory, a wholesaler is a matchmaker, as the second step in the process is to find someone interested in buying the property. The wholesaler will get a property under contract, but not actually buy it, and then sell or assign that contract at a higher price to an investor and pocket the difference between. For example, if you get a property under contract for $120,000 and find a buyer willing to pay $140,000, you earn the $20,000 difference. You could repeat the process several times a year to earn a full-time income. To succeed with wholesaling, you'll need a lot of real estate investing experience and a strong network of investors looking for properties to buy. Wholesalers typically work as part of a power team, which may include real estate agents like myself, acquisition specialists or people that acquire properties, general contractors for the repairs or renovations, selling specialists or what's called a disposition team, processors, marketing managers, and office assistants. Obviously, people can work in multiple of these positions. Although the knowledge and experience requirement is high, wholesaling is a low-risk real estate investing strategy that doesn't require much investment capital. However, here is the kicker. As of July 1st, 2024, through legislation HF 2394, the Real Estate Wholesaling Consumer Protections Act, wholesaling was outlawed in the state of Iowa, both assigning contracts and double closing. The penalties can actually be quite high, as like $10,000 or 10% of the sale of the home. There are a few ways to go around this by having a real estate license or by working with an investor-friendly agent like myself. Number 7, turnkey. Turnkey real estate refers to buying a fully renovated or newly constructed property ready for immediate occupancy or that's already rented. These properties are often marketed as low-maintenance, passive investment opportunities for real estate investors looking for rental properties that will provide immediate cash flow after closing. A potential disadvantage of investing in a turnkey rental property is that it usually costs more than other properties. Because the construction or renovation is already completed, you may not have any control over a property's appearance or features. Number 8. Mobile homes. A mobile home park is a type of commercial real estate where multiple mobile homes are located and rented. Parks may also consist of lots with water, sewer, and electrical hookups that you can rent to mobile homeowners. The property could also include ownership of the mobile homes, which are then rented out similarly to apartment units. There are several important benefits of investing in mobile home parks to consider. They can provide a steady rental income stream and also appreciate over time as the lots increase. Because they are more affordable than other rental properties, investing in mobile homes is also a great real estate strategy for those who don't have much capital. Just a few of the many benefits of mobile home parks include recession resistant, because when times get hard, people look for affordable housing, have long-term tenants because people buy their homes in the park and it is very costly for them to move out. Most maintenance and capital expenses are covered by the mobile homeowners as they own their own homes. They have great financing options and tax benefits as they are seen as commercial properties, and lenders like 21st Mortgage help people purchase mobile home parks. Number 9, foreclosures. A foreclosure occurs when a lien holder reclaims a property after someone can't keep making the payments. The bank, credit union, or other lender will then take legal possession of the property through foreclosure and sell it to recoup the money they loaned on the property. The foreclosure process varies from state to state, but usually involves the property owner first receiving numerous notices. This is followed by legal procedures that lead to foreclosure. Foreclosures usually require a lot of time, energy, and effort. When some people vacate foreclosed rentals, they leave them in poor condition. It's common to walk into a foreclosed property and find significant cosmetics and even structural damage. Sometimes the property may even still have people living in it. Although they can be profitable, real estate investors need a lot of experience and powerful team of inspectors, contractors, and real estate attorneys to make this particular strategy worth it. If you can find the sellers before the official foreclosure process, you can look to purchase these properties subject to or subject to the existing lien. This helps save the seller's credit and keep them out of the painful foreclosure process altogether. There is a specific way to do this though, to protect the seller and the buyer, so please feel free to reach out and I can help you go over this process. Number 10, storage spaces. Self-storage facilities are a type of commercial real estate that consists of multiple storage units on a lot that people can use to store their possessions. They are usually rented monthly. For example, some people may only need to rent it for 1 month, while others may rent for years at a time. Real estate investments in storage spaces can be more complex than single-family home rentals because they involve different regulations, tenant demographics, and property management requirements. The property advantage of self-storage facilities over other real estate investments is that they are comparably easier to maintain. Although some facilities are temperature controlled, many are little more than a simple metal building on a concrete slab. This allows you to enjoy rental income without dealing with the maintenance issues common with other property types. Number 11, real estate mortgage notes. A note is a legal document where a borrower promises to repay a mortgage. There are several investment strategies involving mortgage notes, and one of the most common is to purchase them from lenders. Lenders may agree to this so they can issue new loans to borrowers. Investing in a real estate note means you aren't buying the property. Instead, you become the new creditor. The primary advantage of this strategy is that you can earn passive income without ever being a landlord. Notes have higher rates of return than traditional low-yield bonds offered by banks and credit unions. There are also several different types, including fixed-rate mortgages, adjustable-rate mortgages, balloon payment mortgages, and interest-only loans. Notes are a good option if you want to invest in real estate, but don't want to be a landlord. However, you will need at least $20,000 or more to purchase a note. Number 12, real estate investment trusts, or REITs. A real estate investment trusts are similar to mutual funds and are often traded on the stock market. Instead of investing in stocks, they invest in various rental properties. Large real estate investment groups usually manage these REITs. A real estate investment trust is the easiest, most affordable way to become a real estate investor. You could be investing in REITs already and not even know it. In the US alone, REITs own more than $7.8 trillion in gross real estate assets as of July this year. There are more than 200 publicly traded REITs that you can invest in, and most trade for under $100. You can buy and sell them through a traditional brokerage firm such as TD Ameritrade, E-Trade, or Charles Schwab. Many online apps allow you to invest in REITs such as Robinhood, M1 Finance, and Fidelity. If you remember from a previous video, REITs bring an average return of 11.8%. Number 13, land. Investing in land for real estate refers to buying raw land to hold on to it for some time and then selling it for a profit. The land can also be developed. This investment can be made for residential or commercial purposes, such as building single-family homes, apartments, or commercial buildings. If this land is rural and has the capacity, you can also look to rent it out short-term to people looking for a place to do outdoor activities like camp, hunt, fish, or ride off-road vehicles. It can also generate passive income by renting it out to farmers for agricultural uses. Some important risks, however, include zoning changes, economic downturns, and difficulty finding tenants. Land investments require careful research and analysis of the local market and future development plans. Number 14, commercial property. Commercial properties used for business purposes often have longer leases and more steady passive income streams. A commercial property may be an office building, a warehouse, retail store, or something else in that nature. Commercial properties like apartments or single-family homes may be more expensive than other rental property types. They also tend to be vacant for extended periods of time. Someone new to investing should consider residential properties first to gain experience before investing in the commercial side. If you specialize in other areas of investing and would like to share, please leave a comment down below and we can have you on the channel to go over your particular strategy. Don't forget to hit the like and subscribe down below, as in the next video we cover long distance real estate investing and why you should consider it. If you're looking to invest here in Iowa, I'm a local agent here and love to sit down and chat about how I can help you grow your portfolio. I'll put my contact info down below. I look forward to hearing from you.